Hi, this is Mike Larson for Money and Markets TV. It's official. The Federal Reserve has ventured into the twilight zone. Not only did Ben Bernanke commit to unlimited money printing, he actually admitted that he wants to create new asset bubbles in things like real estate and stocks. But no matter how many times Bernanke tells us that more monetary easing will boost the economy and bring the good times back, the evidence tells a different story. One that says past money printing operations from QE1 and QE2 to Operation Twist 1 and 2 just aren't working. Consider the most recent data. We just learned that industrial production plunged 1.2% in August, far below forecasts and the worst reading since March of 2009. And judging from the regional manufacturing surveys starting to roll in, September is not going to look any better. Meanwhile, retail sales barely ticked up last month, disappointing economists and investors who were expecting a 0.4% increase. And on the employment front, average hourly earnings plunged 0.7%, their biggest decline in more than 3 years. So clearly, all the Fed's monetary horses and all the Fed's men aren't doing anything for jobs or growth. But what they are doing is causing more inflation. Prices at the wholesale and retail levels both posted their biggest monthly increases in 3 years in August. And a key index that tracks inflation expectations about the future, one in the bond market, just surged to a 6-year high. The bottom line is that the Fed's money printing policies are driving commodities sky high, and that's helping Wall Street speculators. It's also causing the real income of average Americans to plunge, and that's siphoning off growth from the real economy. Yet somehow, in Fedland, this is considered progress. In this type of environment, it can be difficult to ignore the irrational exuberance in the asset markets and focus on what's important. But if you have any doubt that we're still in real trouble, just listen to one of the companies considered a bellwether for the overall economy, FedEx. The worldwide shipping firm just cut its forward earnings guidance for the first time in June, citing slowing demand for its services. Then it cut its guidance for a second time earlier this month. And then, only this week, it cut its future guidance again. That's 3 warnings in 4 months, a sign that business is deteriorating at a rapid and unexpected pace. Diversified manufacturing firm 3M piled on this week too, saying its goal of 7% to 8% revenue growth was likely unattainable. The company makes everything from Post-it notes to electrical connectors to stethoscopes to tape, and it operates in every corner of the world. Weak results from Bed Bath & Beyond, which was forced to cut prices to lure tapped-out consumers, hurting profit, spooked investors even more on Wednesday, and so did an epic warning from Norfolk Southern. The leading railroad firm said declines in coal and merchandise shipments will slash revenue by $120 million, causing it to miss quarterly profit targets by as much as 28%. So I'm playing it safe, and I encourage you to do the same. Outside of a few select companies and asset classes, don't take on too much risk. I also recommend maintaining downside hedges against the possibility that the funny money rally has carried us about as far as it can. I'm Mike Larson for Money and Markets TV. Thanks for watching.